Uh, a payment network is the invisible plumbing of our modern economy. It is the complex system that allows money to flow from one person to another, from a customer to a business, from a worker abroad to their family back home. These networks are essential for commerce, trade, personal finance. They are the highways upon which value travels. For decades, one name has dominated this landscape: Visa. Its logo is one of the most recognized symbols on the planet. Many people use a Visa card every single day. It represents the established, trusted, traditional way of handling digital payments. Now, a new kind of payment network is emerging from digital currencies. Pi Network is one such contender. Built on blockchain technology, understanding Visa requires looking at the relationships it maintains with a host of financial players. Visa itself does not issue credit cards or lend money to consumers. Instead, it operates as a massive communications network that connects thousands of financial institutions. When you receive a Visa card, it is from your bank, which is known as the issuer. This bank has a partnership with Visa. When you use that card to purchase a coffee, the coffee shop's bank, known as the acquirer, requests payment through Visa's network. Visa acts as the secure middleman, ensuring the transaction is valid and that the funds are correctly routed from your bank to the shop's bank. This intricate dance happens in a matter of seconds. When you swipe tap insert your card, a request for authorization is sent through the acquirer to the Visa network, called VisaNet. VisaNet instantly forwards this request to your issuing bank. Your bank checks your account for sufficient funds credit. Your bank sends an approval. Pi Network operates on a completely different philosophy, one born from the world of cryptocurrency and blockchain technology. At its core, Pi aims to eliminate the need for the traditional intermediaries like banks and payment processors that are central to the Visa model. It is built on a blockchain, which is essentially a shared digital ledger that is maintained by a distributed network of computers. Instead of one central authority like Visa authenticating transactions, the community of Pi users collectively validates and records them. This decentralized approach is the key to its proposed benefits of lower costs and greater accessibility. The system is designed to be incredibly easy to join. Unlike applying for a bank account, which can require extensive documentation and a physical visit, anyone with a smartphone can download the Pi Network app and begin participating. This process, known as mining Pi on your phone, is designed to be lightweight and not drain the battery. It serves as a mechanism to distribute the new digital currency, Pi coins, to a wide user base while also verifying the user's commitment to the network. The goal is to build a large and engaged community first, creating a network effect before the currency has a mainstream, exchange-listed value. When a user wants to send Pi coins to another person, the starkest difference between Visa and Pi Network lies in their approach to fees. Visa's fee structure is a complex web that supports its vast ecosystem of bank security infrastructure. Every time a Visa card is used, the merchant pays a fee, typically ranging from 1.5% to 3.5% of the transaction value. This fee, known as the merchant discount rate, is not just one charge, but a bundle of different fees. The largest portion is the interchange fee, which goes to the cardholder's bank to cover risks and rewards programs. Smaller portions go to the merchant's bank and to Visa itself for processing the payment. These fees, while small on an individual basis, create a significant financial burden, especially for small businesses operating on thin margins. For a small cafe selling a $5 cup of coffee, a 2.5% fee means giving up 12.5 cents on every cup sold. Over a year, this can amount to thousands of dollars in lost revenue. For consumers, the costs are less direct but still present. Businesses often bake these payment processing fees into their prices, meaning everyone pays a little more. Furthermore, cross-border transactions on the Visa network often incur additional charges for currency conversion, making it an expensive option for sending money to family overseas. Pi network, by its very design, aims to dismantle this costly structure. By enabling direct peer-to-peer transactions on its blockchain, it removes the need for multiple banking intermediaries, each taking a cut. The network still requires a small fee to prevent spam. When it comes to payment speed, the user's experience can vary greatly between the two systems. Visa has perfected the art of the near-instant authorization. When you tap your card at a checkout counter, the approval message usually appears within 2 to 3 seconds. This rapid response is crucial for modern retail. Millions of dollars have been invested in Visa's global network, VisaNet, to keep this process seamless and fast. However, that initial authorization is not the final settlement. The actual transfer from your bank to the merchant's bank can still take 1 to 3 business days. Visa's true strength is its unparalleled reach. The network is accepted by tens of millions of merchants in over 200 countries and territories. Pi network promises fast transaction speeds too, but differently. A Pi transaction is final once confirmed and added to the ledger. Pi's team expects transaction finality in only a few seconds. Trust is the currency of any payment system, and Visa has accumulated a vast reserve of it over many decades. Its security model is multi-layered, involving the bank's, the merchant's, Visa's own sophisticated fraud detection systems, which analyze millions of transactions in real time to spot suspicious activity. A key pillar of this trust is consumer protection. If your physical card is stolen or your card details are compromised in a data breach, you are protected by zero liability policies. You can simply call your bank, report the fraud, and the unauthorized charges are typically reversed. This safety net gives consumers immense peace of mind. This centralized system, while secure, is not without its vulnerabilities. The data breaches that regularly make headlines often involve hackers targeting the large, centralized databases of merchants of payment processors. Visa operates within a well-defined and highly regulated global financial landscape. Its operations and partner banks are subject to strict laws and oversight worldwide. These regulations are designed to prevent financial crimes like money laundering, terrorist financing, and to protect consumers from predatory practices. Banks must perform Know Your Customer checks, verifying customer identities. The framework is complex and sometimes burdensome, but it provides stability and legitimacy for governments and large institutions. Visa is a compliant, predictable part of the formal economy. Transactions on the Visa network are legally recognized and enforceable. If a buyer and seller dispute arises, there are established legal channels and chargeback procedures to resolve it. Pi network and the broader crypto world exist in a much more uncertain regulatory environment. Many governments are still grappling with how to classify and regulate digital assets. Some countries have embraced them. Access to financial services is a critical dividing line in the modern world. Visa's model is fundamentally tied to the traditional banking system. To get a Visa card, you almost always need to have a bank account. While this is straightforward for many people in developed nations, it represents a significant barrier for a large portion of the global population. According to the World Bank, approximately 1.4 billion adults remain unbanked. These individuals, often living in developing economies, are excluded from the digital payment ecosystem that Visa represents. Lack of necessary identification documents, physical distance to the nearest bank branch, high account fees, a general distrust of financial institutions. Without a bank account, these individuals cannot easily receive digital payments. They cannot save money securely or build a credit history. They are often forced to rely on cash, which is inefficient and can be unsafe, or on expensive and slow, informal money transfer services. This is where Pi Network's approach offers a potentially transformative alternative. The only requirements to join the Pi ecosystem are a smartphone and an internet connection. With the proliferation of affordable mobile phones across the developing world, this model dramatically lowers the barrier to entry. In summarizing this comparison, it becomes clear Visa and Pi Network are not just two competing companies. They represent two fundamentally different eras of financial technology. Visa is the pinnacle of the centralized bank-centric model. Universal acceptance, robust security, deep integration with the global legal and financial order. Its weaknesses are the flip side of its strengths. Reliance on intermediaries leads to higher fees. Connection to the traditional banking system excludes billions of people. For now, Visa remains the undisputed king of everyday digital payments, a trusted and reliable workhorse. Pi Network, in contrast, is a bold experiment in decentralized finance, nearly free, instantaneous, accessible to anyone with a smartphone. It champions a vision of a more inclusive and efficient financial future, powered by community and by cryptography, rather than corporations and banks. However, this vision is still in its infancy. Achieving price stability, navigating uncertain regulations, building a merchant network to match Visa's head start.